Hi, and welcome to this week's look at the major stories affecting the markets so far. And where to start? Well, we're going to start in the UK, and the FTSE 100 bounced back off the back of the inflation news. So the UK, as we know, has been suffering from the highest inflation rate of any of the G7 countries. But Wednesday saw the latest inflation data for the UK released, and for once it was good news. Now, CPI came in at 7.9%. That was against a forecast of 8.1% and the previous figure of 8.7%. That's the year-on-year figure. Now, core CPI dropped from a 31-year high from 7.1% down to 6.9%. So finally, a fall in inflation, which is good news. We'd hoped for this a couple of months previously, but as we all know, it hadn't materialised. But what effect did that have? Well, the pound fell against the US dollar and pretty much all other currencies, falling to around the 1.288 area. It's approximately Thursday 129.15 now, so a small recovery. So pound fell, but the FTSE 100 rose quite sharply, rising from the July lows by about 5%. And in fact, that's continued through Thursday morning. It's up about 2.72% in the last 5 days. Now, participants in the market now expect a bit of an easing of the Bank of England's monetary policy. Not huge, and we're not talking about pausing here, but the interest rate decision that's due on the 3rd of August is more likely to be a 0.25% increase rather than the 0.5% increase we were expecting up until these figures came out. Well, that's great news for the UK consumer, obviously, particularly those people with mortgages, etc. Quick look at the chart now. It shows the price has broken the descending channel and the resistance at 75.55. We may well be looking at a potential consolidation period now between that 75.55 level and 76.90. But obviously an awful lot of economic data is still to come, and of course, 3rd of August is not far away in terms of the next potential interest rate increase. So keep your eyes open and your ears to the market, and we'll see what happens with the FTSE in the coming weeks. Secondly, we're going to take a look at a currency pair, and that's the euro against the US dollar, and it's reached a 17-month high. Well, despite the pound falling against the dollar off the back of the CPI news, in truth, the last week or so, the dollar index has posted its worst week of 2023. This is amid news of declining inflation, obviously, in the US. On the other hand, the Eurozone inflation is not falling as fast, well, not as bad as the UK. And there is certainly some ECB officials considering the fact that interest rate rises are a must moving forwards for the rest of 2023, which would of course support the euro. Now the chart shows demand dominance. The price has risen above 1.12 for the first time in 17 months. And this level 1.12 has influenced price dynamics in the past. It's worth keeping your eye on. It's also gone beyond the upper limit of the ascending channel, as the chart shows us. Now we could assume the market is in a vulnerable position off the back of this and potentially ready for a pullback. And it's going to need some serious effort by the bulls to maintain a foothold above 1.12. In fact, the past couple of days, the markets and market participants were keeping a keen eye on further data coming out, such as the Eurozone CPI and the US retail sales data that we've had. Well, they haven't had a huge impact, I would suggest, one way or the other. Thursday morning has seen attempts above the 1.12 level, but it does seem to keep easing back to around that point. So volatility is there, even if it's quite rapid in short term. So don't forget your risk management techniques. And could we see a further push in the euro? Well, it's going to take a few days to find out. Now we're going to turn our attentions to commodities. I'm going to have a quick look at crude oil. There's some mild volatility in there as China's economic outlook builds a little bit of positive sentiment. Now, Brent crude oil eased from last week's high of around 81.50, closing Tuesday at 79.58 a barrel. Let's not forget, though, that it was around $72 at the end of June, the price has steadily increased. Not a lot of change so far Thursday, around 79.70, a little bit more positive than it has been. And some of that positivity has come from a glimmer if you like, of positive sentiment in a statement from the Chinese government. It was quite a generic statement, but they said they are committed to supporting economic growth within the country. And what effect does that have? Well, China, as we know, is the largest importer of crude oil in the world. Hence, we actually saw a 1% increase in the price Tuesday afternoon during the session off the back of this statement. No doubt, increased demand from China could see a further rebound in that price of crude oil. This is good news. And obviously, China is now a major player globally. And when we talk about economic growth in China, it is a bit of a key driver for the markets. But we have to counter that sort of slightly positive sentiment with ongoing issues and the potential of increased hostilities from Western governments towards one of the world's largest oil producers in Russia. We've seen the effect that over the last 12, 18 months that geopolitical concerns are having, including, a bit of a fuel shortage in Europe last winter. You've got to continually monitor both geopolitical concerns at the moment and China's economic landscape to try and gauge what could happen next. Throw on top of that we saw US inventories down last week as well. That was down 797,000 barrels. The week before, it was up 3 million barrels. So that's showing a fluctuating trend in inventories as well. All of these factors can have an impact. And it's clear that supply and demand still dominate the market for crude oil. It's a complex market. A little bit of volatility in there is what everybody likes to see. But you've got pressures from all sides when it comes to oil positivity from China. You have oil-producing countries trying to protect the price of oil. You've got, the US trying to hold the price of oil back with its own inventory. So you've got to take all of these factors into account when it comes to trading crude oil. It's a difficult market, but it's one that's been around for a long time and one that probably still will be. So add all these factors in when you're looking at decision making, not just technical analysis, fundamental analysis in terms of geopolitical concerns as well. Okay, finally, we're going to take a look, as we often do, at an individual share and equity. And we can take a look at Netflix. Reporting season is in swing again in the US. Netflix, obviously a major global player these days. But is Netflix ending its bull season? Well, in October 2022, the price was about $250 per share. And since then, that price has more than doubled. In fact, we did a piece back in October titled, "Is Netflix starting a new bull season?" Hence today's title. And has it ended after Wednesday's report? Well, if we look at the positives from the report, it's added nearly 6 million subscribers in the quarter. Now, that was against a forecast of about 1.9 million. So that's a pretty positive figure. At the end of June, it has 238.4 million subscribers worldwide. But now for the negative news, and that was one of revenue decline. Revenue was expected to come in at 8.3 billion, and its actual was 8.1 billion. And if you think that actually there was a large difference in new subscribers compared to the forecast, that makes it look slightly bleaker. And the company said in a letter to shareholders they still have a lot of work to do to accelerate growth again. Now, on the eve of the report, the price went up on the rumours of these new subscriber numbers, close to the $500 mark, but it fell almost 9% post-market. We're looking around an open of $440 per share. That's $440 per share Thursday. Quite a way off the $500 market hit on the eve of the report. Now, this could suggest a bit of an abrupt change in market behaviour, and it could well signal the end of a months-long rally. A surge in volatility such as this may help large stockholders take some of their profits, particularly if they are seeing potential further decreases in revenue. We've also got things such as the actors and authors strike ongoing and disputes with companies such as Netflix, which could have an impact on their output. And of course, it's in a marketplace of increased competition. Now, the median line on the chart is now seen as support. If that breaks down, it could well confirm this change in market sentiment. At the moment, it's a bit up in the air. Was it just a reaction to, slightly disappointing revenue figures, and they overshadow the positivity of the increase in subscribers? So that median line could well turn out to be a key indicator to whether this Netflix bull season is over or not. As ever, don't forget your risk management techniques, and we wish you luck in your trading in the week ahead. Bye for now.